Welcome everyone to the Daily Bread from the Daily Threads. I love going on to social media posts, X, Reddit, YouTube, what have you, in order to find what people are saying about the macro landscape. Yes, I love taking a look at the data myself, but when we collate together what people are saying, it can be pretty insightful, at least getting the pulse and the sentiment. So that's what Daily Bread is. So let's just jump right into it. So the four stories we want to take a look at today starts off with Stackholler, who talks about the crash that is happening right now. So we have here, let's read his posts from Stackholler on X saying, "Hey bears, the crash is happening right now. It's not just going the direction you thought it would. Capital is fleeing into scarce assets as the global sovereign debt bubble bursts into slow motion. You've had 5 years to understand this. If you still can't see it, you're not going to make it. U.S. long bonds, TLT, are down 37% in the last 5 years. Add another 30% loss of purchasing power of the dollar. And then consider that any of the assets you may want to buy with those dollars are probably up at least 100%, and in many cases, far more. This is a bear and bond holder massacre. Bitcoin and gold are just the easiest ways to protect yourself. Been saying it for years. Now, brains are being replaced by GPUs and soon muscle by actuators, which means there are incredible opportunities for investors to make up for lost time. But you must understand what's happening first. Waiting in dollars for a crash is like waiting in a burning building for the fire truck to arrive. Just get out of the building." And then he has here a chart of gold just rising and rising and rising versus TLT. Totally understand that. I thought this post was a nice exemplification of what is happening, or how to think about the debasement of currency that is happening right now. People like to scream inflation, 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 but when we actually take a look at what's going on, is that there seems to be a fundamental issue, there is a fundamental issue with the value of the dollars themselves. And however you want to shake it, we know that performance is going to chase performance, is going to be pulling in capital, and that's what we're seeing. We're seeing gold going up, we're seeing Bitcoin going up, we're seeing indices going up, we're seeing performance being chased. So what we have here is the debasement of the currency. It's just plain and simple, and we're seeing that reflected within the charts. The charts are going up and to the right when it comes to high-performing assets, indices, anything that takes advantage of the debasement of that currency, which makes value assets a little bit harder to buy. All right. Moving on to the next one. This comes from Raoul Pal over at the Real Vision. Pretty interesting here, this idea that the business cycle is actually longer now than it normally is. This is something that's been coming up as I've been talking about the bullish cycle for Bitcoin specifically. Bitcoin, surprisingly, has a bottom to top cycle of 1,064 days. And we've had that over the last two cycles, and that's what I was expecting for this cycle. But I was also expecting higher prices for Bitcoin. So this idea of why isn't Bitcoin or crypto higher in general versus like it was in previous years? We know it's always more muted every cycle, but this seems to be really muted. And if there was going to start being a top-in pattern or a crash, I would have expected it to be starting by now. By October 20th, we would get that sort of candle, or that sort of last hurrah. But we're not seeing any euphoria within the markets. We're not seeing any of that. So what's going on? Well, there's a great video that's on Real Vision that is about Raoul Pal talking about this idea that the debt cycle that we're in, the liquidity cycle, is actually extended by an extra year because of refinancing of debt. So let's just see what the preview here has to say, and you're going to go take a look at that longer video on YouTube.
So recently we noticed that, hey, the ISM, and you've heard Julian and I trying to understand, okay, what's changed in our framework? Our job is to understand and double test our framework at all points. So when something major is changing, which was the ISM not fitting the 4-year perfect sine wave, we started thinking, what's going on here? The ISM is more subdued than it has been ever. And we found out that the debt had been moved in 2021-22 because interest rates went basically back to zero. They managed to extend the curve by issuing further out, and they extended the debt maturity from 4 and a bit years to 5.4 years, creating a new longer cycle. Now, we don't know what length the next cycle is. It depends on where they refinance this entire cycle at. But right now, we know we've probably got an ISM and a business cycle that extends well into late 2026, and that will affect asset prices. So this is why crypto markets have been more subdued than people expect, and we'll come onto that in a second as well.
That's been pretty fascinating because not only with Bitcoin rising off the lows that we saw recently, so I mean, literally, Bitcoin went up 15%, essentially in a straight line from the lows here from September 26, and it just rose 15% up straight up into the air. I think we're even higher than that now from the lows. What are we at? Well, no, 15%. So that was pretty significant. But we also had the same thing in equities. We had NASDAQ go up. We had the S&P go up. We have gold just rocketing with no end in sight. And these are all pointing to the idea that the refinancing cycle is longer out, and that the euphoria and bull run and leverage longs and the whole thing, the meme stocks and all that, that we're still in that window. And we're going to get that over the next 6 to 12 months. Pretty interesting and something to look at. Lends itself to that the post previously from the hauler. That's, hey, don't be shorting now. Shorting is not the way to riches in this particular market. Picking the top is going to be pretty difficult. All right, moving on to our third story is from Japan. So Japan's big move. So there's this idea that there's apparently a likelihood that the new prime minister of Japan will be, am I saying her name right? Sanae Takaishi. And it's always interesting when a major change like this has happened in a major country, because it can have major financial ramifications throughout the world, especially for Japan. So different nations have different positions within the global financial system, especially the global dollar system, and how liquidity gets injected within the system. So, for example, China, as we all know, is one of the production basins for the global dollar system, and so they're generally speaking 6 months to a year, sometimes a year and a half ahead of us in the cycle, since they're further up the chain. So what they do affects us in a particular way versus what, let's say, Germany does, because their manufacturing base has a different effect of what happens to us, or policy of what happens with the oil market inside of the Middle East or with Russia also has different effects based on consumer spending and inflation inside of the Western nations. Now, Japan, and there's all kinds of dynamics that happen in Japan, and people more versed in it than me can speak to it, but Japan does, in a sense, prop up the U.S. Treasury market, prop up the U.S. financial system to some degree, because of their large debt to GDP ratio over there, and the just how their bond market works and their yen works. A lot of that money would come over to the Western world, especially the United States, in order to gain performance, because their assets weren't performing in the same way. But the idea here is that growth is being aimed for in the Japanese stock market by the potential new PM, which is causing the stock market to rise. So let's go ahead and read the story before we continue. So Japan just shocked the world. This is from stockmarket.news. Handle is @_investingq. Japan just shocked the world. Sanae Takaishi is now prime minister, or potentially prime minister, Japan's first ever female leader, and she's coming in swinging with huge stimulus plans. Markets are ripping and investors everywhere are bracing for what comes next. Japan's Nikkei 225 just hit a record high of 47,717, surging 4.26% in a single day. Investors are piling into Japan on expectations of massive stimulus, new tech subsidies, and defense spending under PM Takaishi. This rally cements Japan as Asia's top performing market this quarter. Japan's surge is lifting exporters and industrial giants as profits climb and optimism spreads across Tokyo's markets. But at home, consumers are facing rising costs for food, fuel, and housing. Inflation pressures are mounting again, and policymakers are under growing pressure to respond. Meanwhile, the bond market is flashing warnings. Japan's 40-year yield has climbed back to all-time highs as investors demand higher returns to finance a government already owning more than twice its GDP. Fiscal credibility is quickly becoming the market's biggest question. Takeshi's plan? Spend big. Billions for rural development, infrastructure upgrades, and national defense. Tech and industrial giants expect a windfall from semiconductors to shipbuilding, but can stimulus alone offset decades of weak wages and a shrinking population? Japan's debt-to-GDP ratio is now over 240%, the highest among advanced economies. Takeshi argues that growth comes before fiscal health, but every new bond issue pushes investors closer to question whether Japan can sustain its massive debt load. Now, what I care about for the Japan market, as I was saying, is the idea of what will the Japanese do with their capital. Will they park it within their markets, within their stock market because it's going up, or will they continue to support other Western markets abroad? And this could be liquidity draining. So we'll see what happens when, if and when the new prime minister gets ratified. Now, there is a question of whether a mandate is really there for her to do what she seems like she might want to do, because they would have, I believe, like a minority government. And so this thread goes on to explain that there'll be a coalitions that need to be done in order to get things passed. And we all know that means they're going to have to leave some things on the table. They can't have everything that they want. They're going to have to compromise. So we'll keep an eye on that. And finally, I want to touch on this story from Kobeissi letter. This is about the VIX. So Kobeissi letter on X says, this has never happened before. The volatility index VIX has risen 1.36 points over 5 consecutive days. Over the same time period, the S&P 500 has gained 1.09%, also advancing for 5 days straight. Since the creation of the VIX in 1990, both measures have never recorded such a streak, according to Goldman Sachs. The closest were a 4-day streak of the VIX rising alongside the S&P 500 in 1995 and 1996. This comes as total call option volume has surpassed 40 million contracts a day on average over the last 20 trading sessions for the first time. Why is volatility rising with equity prices like never before? This is something I've been wanting to see for a while. A greater minds than me have talked about this. Ken Carson has talked about this as well. This idea that, and Mike Green, the idea here is that volatility or a rise in VIX doesn't necessarily mean the markets go down. Volatility is just the range of possible outcomes, and the range of possible outcomes can be wide, even to the upside. And so you can have volatility that goes up even as markets go up, because I believe the options for the VIX are not just for puts; they're also for calls as well. And so seeing market up, vol up, or market down, vol down. These types of permutations can happen again and again and again as we have forced buyers and for sellers within the market. We have different market makers dynamics, and most importantly, we have volume within the derivative space, especially the option space, especially short-dated option space, that is higher than ever before as retail participant becomes far more prevalent within these spaces. Now, what happens when we move off and the FINRA proposal to the that needs to be ratified by the SEC about the rule of having $25,000 inside of an account in order to trade futures? When that drops to $2,000, let's see what that does. Robinhood is out there trying to tokenize, not just them, but a bunch of other people trying to tokenize different types of assets to draw more traders within the markets. It's a trader's world, and I firmly believe that people are going to have to learn how to trade, either directly or indirectly. They're going to have to learn how to deal with markets. They're going to have to be plugged into this, because these markets are just going to keep going up and to the right. Even if we have the short-term downfalls and blips, it'll be like we saw with COVID, like we saw with the tariffs, like we saw with Volmageddon, like we saw with all these different things. Short-term drop, even up to 20, 30, 40, 50%, and then rise back up afterwards. And the people who are not exposed to financial markets, don't have assets like that, will suffer greatly. And the divide between those who have and those who have not will increase. But let me get off my soapbox. That's not what we're here for. This has been the news of the day, and we'll be back tomorrow with another Daily Bread.